Volkswagen today said it is planning to invest $7.1 billion on manufacturing in North America as it transitions to all electric vehicles, targeting the end of the decade for that. Volkswagen Group of America President and CEO Scott Keogh is joining us now. Scott, apparently you and I missed each other in Austin, Texas last week. We were ships passing in the night, unfortunately, but we're glad to have you here now. When we look at the plan for this money, among other things, it's my understanding that you are going to integrate your assembly lines for gas-powered and electric vehicles. How does that work exactly? Because the construction process, from as I understand it, is pretty different.
Yeah, actually, we're doing it right now in Chattanooga, and I was just down there just a few days ago, and it's working quite well. I mean, you have to look at it. A factory is basically paint, body, and assembly. So the paint shop is merged, the body shop is merged already, and then we have two separate assembly lines. But actually, the integration works quite well. The hats of two vehicles are similar. Of course, as you know, the platform's entirely different. But for us, it works because it meets what's happening in America. America is undergoing a transition, and you need the factories to represent that transition, basically.
God, I love the new bus behind you. Talk to us a little bit about it. How big of a sales driver do you think it could be for VW?
I think first and foremost, it's an absolute just brand love vehicle. Having spent some time down in Austin, everywhere you go, it puts a smile on someone's face. So I think the sales will be great. The fact of the matter is I've never seen this much demand for a vehicle. I get emails from dealers. I get paintings from small children. I get hugs from grandmothers. They want to be first in line. So this thing just covers every spectrum imaginable. So I think it's going to be a home run. We just gotta get it here.
Well, yeah, Scott, to that point, are you going to be able to make Granny and her grandson happy here? Can you get these vehicles to market given the supply chain constraints we continue to see in Autoland?
Look, this vehicle is going to hit the market in 24. We want to do a specific version for the U.S. market. This is going to have a third row. It's going to have a bigger battery. It's going to have a performance drive unit. I think and hope things will be a little bit more stabilized. But of course, the instant I say that, there seems to be some new global issue. But I feel relatively confident. We've done a decent job at Volkswagen. We're up 15% last year, so we navigated the chip crises pretty good. If I look at our battery supply with what we have coming from SK Innovation in Georgia, relatively stable. So I think we've covered our bets. And frankly, that's what this investment's about, continuing to localize to get stability in the region on many of these things.
So, Scott, talk to us a little bit more about that, because obviously, leaving the bus aside for a second, it sounds like you all have managed to stay relatively well supplied in what's been a really challenging environment. You've got the partnership with SK, but a lot of other stuff still has to be imported right into the country, including chips. What do you think, and what is this investment going towards that's going to maybe help alleviate all of that in the longer run?
Yeah, I think the first biggest thing is this investment's strategic. We're undergoing the massive transformation into electrification. So what does that mean? One's more electric products. So we have the buzz behind us. We'll be announcing more SUVs. So investing in products. Obviously, the factories. We made the first invest in Chattanooga, as you know. But of course, we have a factory in Mexico. We have component plants. These all need to be transitioned. So it's a massive invest into the factories. And yes, all of that is certainly helping us stabilize the situation with regard to chips. If I look at chips themselves, at least somewhat in the second half of this year, it seems to be getting in a better position. And hopefully that will reflect itself. But make no mistake, the market is still structurally underserved from a chip point of view. You know what's happening with consumer demand, whether it's being from televisions or iPads and on and on. There's still structural in terms of not enough chips being out there. But again, we can navigate it. I think the upside of what you're seeing is the margin and the pricing power in the marketplace, frankly, has never been better. So that's the flip side of this very high demand.
Within the next decade, do you think VW will still be making gas-powered cars for the U.S. market?
Look, I think for us, we'll be at about 55% of our mix by 2030. So that's 8 years away. I think by 2035 or early 2030s, it will be nearly 100%. So I think this spin and adoption is happening rapidly. Now, on some respects, if we're straightforward, it's happening from the legislative point of view. The state of California plus the other ZEV states, that's 50% of the business. They have legislation in place that says 0 by 2035. If I look at what the federal EPA and Biden's putting on the table, they're almost mimicking that. So it's a little blend of the market's heading there, legislation is heading there, and the invest is there. I think if there was two segments I was going to continue to look after, there's vehicles that are still priced in the low 20s right now. I think we're still going to need to be there. I'm not sure if all of America is going to be able to make this leap. I also think vehicles like the Atlas, 3 rows, 4 families, very affordable. I think these vehicles will linger through the early 2030s, from what I can see of American purchasing habits.
And Scott, what you're talking about kind of leads me to the next question, which we've been watching some of the large US-based automakers and investors sort of grapple with where we are in this transition. And I wonder if investors, from that perspective, kind of got a little ahead of themselves, given that what you're talking about is a sort of, as you say, a decade out still, perhaps.
Yeah, look, I think Wall Street does what it does. And what Wall Street does is quite clear. They look to the future, and I think there's no debate the future is heading electric. If you look at it, though, the good news is the big risk at the beginning of this transformation was, of course, the regulations are on board, the investment's on board, Wall Street's on board, is the consumer on board? And the big point I've been making is the consumer does not walk into a Volkswagen or any showroom and say, I need to help Volkswagen meet their regulations, or I need to help Volkswagen because they've made this big investment. The huge news is now the American consumer is on board. And honestly, it's exploding. When we made this bet 3 years ago in Chattanooga, the EV marketplace was 0.4, somewhere in there. Now it's about 6%. We're going to sell 1 million EVs in America overall. So the good news is the American consumer is getting on board, and it's really taking off. I think the truth is, I think it will get to 50 to 60% quite quickly. It's those final percentage points that are going to be the challenge, depending on geography and income and everything else that comes with that.
As part of your role, Scott, in the U.S., you oversee Bentley and Lamborghini. Now, these are two super high luxury brands that, I would argue people flock to these brands, of course, because of the name, but also the driving experience, the sound of a Lamborghini engine, the sound or the experience of a Bentley. How difficult will it be for brands like this to make that EV transition?
I think two things. I think if you look at those two brands, the good news, of course, all of the regulations get consolidated under the Volkswagen Group. So it's looked upon as one entity. So certainly brands like Audi and Volkswagen can help with brands like Lamborghini and Bentley. But the second one, honestly, is a myth. I have no doubts the engineers at Bentley, the engineers at Lamborghini can bring those vehicles to life electrified. I think, as you know, the torque is through the roof, so the driving experience will be insane. If you look at where the battery's placed, it's low and wide. That gives you great center of gravity for vehicle dynamics. So if you look at what they've been presenting, I have no doubts they'll do a proper Lambo and a proper Bentley electrified. So they may be a little bit behind Audi and Volkswagen on the curve, but 100% they have the products and they're coming as well. And honestly, I think those buyers, many of them, it's their third or fourth car, it's not the primary car, are going to love electrification, full stop.
Well, if you guys can make the Mystery Machine electric, I guess anything is possible.
Amen.
Scott,
I like the summer of love that you had. The summer of love that you had on the previous interview. So here's the summer of love right here.
We got to
just go out and buy a Lamborghini. Exactly. Forget the diamonds.
Scott, thanks so much. Just good to see you.
Chatter in D.C. is that the government will extend the freeze on student loan payments beyond May 1st. Our next guest writes in a new blog post, the administration continues to waffle on this issue, and $10,000 in debt should be wiped clean for student borrowers. SoFi CEO Anthony Noto joins us now. Anthony, always great to get some time with you. Before we even get into your blog post, based on your conversations with folks down in Washington, how likely is it that we get another freeze here?
It continues to waffle back and forth. An announcement was supposed to be made a couple of weeks ago, according to the chief of staff of President Biden. That date came and went, and we still haven't heard. This is classic leadership by indecision, and it's exactly not what the country needs. The American people deserve better. We need decisive leadership. We need the administration to take a stand. Kicking the can down the road is not currently going to suit all the needs of the American people. There really needs to be a three-pronged approach, and that needs to be announced before May 1. Number one is there are people that are in distress and that would default on their loans if payments were to begin again. Those people should be given some type of relief. Otherwise, they're going to default and have to go into bankruptcy. There's a second group of people that have an ability to pay, but they have a lower ability to pay today than they did 2 years ago when this student loan moratorium started. And we've spent $150 billion, that's what it'd be, since March of 2020. And this isn't March of 2020 any longer, but some people have gone 2 years without paying their bills, and they're currently in a situation where they can't pay as much. And there needs to be put in place programs for them. And those programs already exist. They just need to be executed and communicated. And then last, there are people that are fully capable of paying the student loans, and they should begin repayment on May 1st. So it's very clear the three needs of the American people. What's not clear is what the administration is going to do to help the American people versus spending another $5 billion a month to fund unnecessarily the moratorium on federal student loan payments.
And Anthony, you're really echoing some of the comments that we heard from Sheila Bair as well. You guys are on the same page in terms of offering that clarity. I'm curious why you decided to speak out on this particular issue. You seem to be pretty impassioned about it, and in the blog post in which you lay out your argument as well. What sort of triggered your desire to talk about this?
Yeah, first, full disclosure, SoFi is in the business of student loans, so we get impacted by this indecision, but that's not the motivation. SoFi is going to be fine either way. We had record revenue in the third quarter. We had record revenue again in the fourth quarter. We achieved over $1 billion of revenue in all of 2021 and our first full year of profitability on an EBITDA basis, all while the federal student loan program has been on hold. The reason why we decided to take a leadership position is someone needs to lead from the front. Someone needs to be a voice of reason to the administration and help them understand the pain and suffering that they're causing by their indecision. The American people deserve to know how to plan for the future. And it's not just the current people with student loans, but it's all those young people that are graduating from high school this year, that are making college decisions right now. How are they going to fund their college education? What are the rules? What are the programs? And so the indecision is causing people not to be able to make vital financial decisions in their lives. And we see it every day. Rates are at still an all-time low, but they're expected to increase 7 to 8 times over the next 2 years. As those rates go up, student loan borrowers will lose the opportunity to refinance at lower rates through companies like SoFi and save tens of thousands of dollars. Additionally, those people that have been saving for the last 2 years, the money that they haven't had to spend on paying back their student loans, they need to know if they can continue to spend or they need to change their budget and start to allocate that to their payments. And so this indecision is causing strife across many different constituencies and the business community.
Yeah, and of course, it's adding to an already beleaguered situation, to your point, just about the student loan burden that so many people have. Anthony, I'm really curious about your personal connection to this, or if you have one. For example, I know you went to West Point, so not a student debt issue there, but I'm curious if this is something you experienced in your own schooling history, or if you're seeing it on a personal basis with other people you know.
Yeah, it's interesting that you asked that question. My younger brother, Tommy, died in 2017, and it was a very traumatic experience for us as a family. And my older brother and I were going through his belongings in his apartment a couple of days after he passed away. And on his desk was a letter from Mohila. I had never heard of Mohila prior to coming to SoFi. And I opened up that letter of a 47-year-old man who had been incredibly successful professionally, and he owed $44,000 in student loans, and he was 47 years old, had done well professionally, had done well personally, and he still had a student loan burden. There are many Americans that have done everything they can to achieve similar success, and they still have this economic burden. SoFi was originally started to help people refinance out of federal student loans that are at exorbitant rates and that subsidize people that don't have the right credit profile, that don't have the right income. And those people have to carry the burden from others. SoFi helps lessen that burden and helps people pay off faster at lower cost. So I do have a personal connection to it. I never would have guessed when I came to SoFi that I would have that connection when he passed away in 2018. But I do, and I see it happening every day in my inbox. My inbox has messages from people that are trying to figure out what to do, and we see the strife and the strain in their lives. So it does impact me personally, and I have a connection to those other people that are trying to figure it out every day as they're trying to budget their lives and plan for the future. And the administration also has a huge fiscal responsibility. It costs $5 billion a month that could be reallocated to people that are in stress, be allocated to the people that have trouble paying back their loans. And instead, it's being needlessly wasted against people that can pay their bills. And it's only adding to the deficit that currently can't even fund additional COVID relief. And so the administration is really making huge mistakes in a number of areas. They need to lead, and they need to lead decisively with real solutions, not political agendas headed into the midterm election.
Anthony, I'm sorry to hear about your loss. I was not aware of that. Just going back to the blog post, you mentioned affluent. What criteria, in your view, characterizes as affluent, just in terms of what you would like to see in terms of debt reduction?
Sure. There's an easy way for the administration to execute a program through self-certification. For those that cannot pay, they self-certify online, and then they work with agency capabilities. It could be servicers, it could be SoFi, to implement a repayment plan or apply for full relief. And then it's done on a financial standards basis. Because there are some people that do have high income that are in a distressed situation for a variety of different reasons. And so what we did in March of 2020 was we allowed people to self-certify for forbearance. And 15% of our borrowers at that time applied for forbearance, and all of them were given it. Today, 99.2% of our borrowers are paying back their refinanced student loans. So the vast majority of people are capable of repaying back their loans today, and should be, versus the government wasting $5 billion on them. That money can be reallocated to the people that cannot pay. And they can self-certify why they can't pay, and then they can execute against a program that the government already has in place. And if they need someone to execute it, SoFi is more than willing and able to help them execute it.
I'll say this. I encourage everybody to please check out Anthony's post over at SoFi. It's very helpful, very insightful, and really what continues to be a developing situation here on student loans. SoFi CEO Anthony Noto, always good to see you. We'll talk to you soon.
Thank you. Thank you, Brian. Thanks for having me.
If you do a Google search on Bitcoin, you can see interest appears to have waned since the peak of last year. Meanwhile, Bitcoin prices have basically traded in a tight range since February. So what does all this mean to shares of Coinbase and its rivals? Lisa Ellis is an analyst at MoffettNathanson and covers Coinbase. Lisa, great to get some time with you here today. You have a $600 price target on Coinbase. Make your case.
All right. Well, in our view, Coinbase is a very unique, one-of-a-kind asset, providing the infrastructure layer for the crypto economy. So you don't have to believe in any particular application of crypto. It can be trading and investing, it can be payments, it can be NFTs, it can be cross-border transactions. If you believe in the future of the technology, which we do, Coinbase is the leading Western regulated on-ramp and off-ramp into the crypto economy. It provides that critical process of helping consumers and businesses migrate between the traditional world, our real world, and the crypto world. And as in a stock, it's a very unique, one-of-a-kind asset, getting in on the ground floor of one of the most transformational technologies over the next decade. In our view, look, it's volatile. We'll talk about that, I'm sure. But if you have a multi-year time frame, this is a extremely unique, attractive stock. And it's trading right now at literally only less than 5 times forward revenues, which is about, to put that in perspective, that's about half the valuation of a stock like Shopify, for example, another very popular growth stock. It's an extraordinarily attractive entry point into this name.
I guess, Lisa, it's Julie here. Hi. I guess the question is, how long do people have to wait, right? Because we have seen the 4-year cycles before for the likes of Bitcoin, right? So does that mean we're waiting another 4 years till crypto and therefore Coinbase comes back?
Well, predicting anything, obviously, when it comes to crypto is always a little dodgy, but the cycles in the past have suggested that after we have a peak year, the following year, of course, is going to be a bit down from that. That's what we expect currently in 2022, because 2021 was a truly banner year. Coinbase delivered over $3 billion in GAAP net income last year. It was unbelievable. So look, realistically, 2022, with the pullback in crypto assets more broadly, will probably be down a bit. But history would suggest that these cycles, bottom and turn within a year. So in our view, if you can even just hang in there for 12 months, all folks will be rolling forward and looking at 2023 and going back into the next cycle. So at this point, when Coinbase first listed last year, right into the peak of a cycle, you're saying like, oof, you probably have to be comfortable with a 2 to 3 year time horizon because we got to get through a trough. Now that we're kind of into that down period, in our at this point, it's like 12 to 24 months. Not too terribly long, realistically, to be waiting.
Lisa, our stat of the day highlighted just weakening search volume for Bitcoin, for Ethereum, for NFTs. What happened here? What is going on? Why is this interest waned?
Well, a lot of that is macroeconomic related, right? Coming off of the pandemic and stimulus payments, where a lot of individuals had time on their hands and money in their pocket to experiment and learn about this space. And now, that we're kind of transitioning out of that, we're naturally going through a lull period. But at the same time, that's an indicator, like the search terms is an indicator of consumer related, like retail demand, which tends to go through bigger peaks and troughs. Institutional demand, on the other hand, which is a big part of Coinbase's business, this is corporations as well as institutional investors investing in crypto assets, working through their institutional platforms, is only going up. That has been a straight line upward.
Lisa, we're very lucky to have you here today because you have an interesting coverage list. So if I'm right, you cover American Express, MasterCard, and Visa. Are you starting to worry about a potential recession, and have you made any adjustments to your numbers for those companies because of that?
Well, the immediate adjustments we have made to our estimates for all three of the payment networks is specifically related to the Russia-Ukraine situation, where Russia and Ukraine contributed about 5% to 6% of revenues for both Visa and MasterCard. That is gone out because they have shut down their operations in Russia, suspended them indefinitely. From a recession perspective, not yet, but we're watching it very carefully, particularly in and around Europe. It's a tricky macro situation when it comes to the effect on the networks, because you've got a lot of pluses and minuses. On one hand, some inflation is actually good for the payment networks because their pricing is based on the dollar value of goods. So actually, they are a good inflation hedge. And they're also still in recovery mode from the pandemic, with travel, entertainment, restaurants, all that discretionary spending that you spend a lot on your credit cards still going up. But then we've got kind of this now nervous offset of, the situation in Russia, Ukraine potentially spreading to cause, a broader macro slowdown, which is a negative. So we love the payment networks. As you saw, they're literally our top three picks because of the recovery in travel. It's literally 25% of the revenues of all three networks pre-pandemic, and it took a nosedive over the last 2 years. That's still coming back in. But to your point, there's a little bit more of a caution clouds on the horizon, I'd say, related to the unfortunate European situation.
Super helpful insights here. Lisa Ellison over at MoffettNathanson. We'll talk to you soon.
Well, we all have been feeling the effects of supply chain shortages in the United States. And right now we want to talk to some folks whose job it is to help get goods around the United States. More than 90% of America's truck drivers, by the way, are owner-operators or small businesses. We're joined now by Grant Goodell, who's Convoy co-founder. This company helps truckers get goods, full trucks around the country, and Jacinda Duran, who is a carrier for Blackburn Energy. You guys have just been driving together. I know, Grant, you've been sort of checking out the business. And I want to start with you, with what you guys have been seeing in your business, as we've been seeing not just, sort of shortages of goods around the country, but also rising energy prices.
Good morning. Thanks for having me. Yeah, we've definitely had some interesting times over the last few months and obviously through the pandemic as well. Convoy primarily works with those 90% owners and small businesses that make up the majority of the trucking capacity in our country. And it's been a challenge for them. I think you've seen all sorts of sort of fuel price spikes. You've seen businesses have to change their supply chain patterns in order to adapt to their customers' changing needs and to the pressures that they're feeling on their own supply chains. And companies like Convoy have had to help those shippers adapt to those changes by providing them with flexible capacity through that network of small carriers.
Grant, what prompted this trip?
It's a great question. So we work with hundreds of thousands of small carriers, but as a tech company and as a tech executive, my personal experience with these carriers is limited to these kinds of ride-alongs. And coming out of the pandemic, it's been fantastic to reconnect with our carriers and experience their lives, the challenges that they face every day, and observe them in action, see the skill that it takes to drive one of these heavy trucks through traffic, through weather, through accidents. All of these, by the way, we experienced yesterday on I-40. And the goal of this is to make sure that we at Convoy fully understand our customers and are able to provide them with the services, the products, and the support that they need to be successful.
You know, it occurs to me, right, there were some tornadoes in the southeastern part of the country yesterday. So hopefully you guys obviously got through it unscathed. Hopefully it wasn't too bad. Jacinda, what has been the biggest change for you over the past 2 years in driving your truck? And what has been sort of the thing that has become the toughest?
Good morning, and thank you for having me. Obviously, as we all know right now, fuel prices, at hand, there's always changing, always evolving. But right now, obviously, it's the fuel prices, squeezing small carriers out right now. Only the strong are going to survive at this point. So, we're riding it out. We're hanging in there, battling these fuel prices. Freight prices are not going up following the fuel prices. So it's going to be the last man standing at the end of this.
Jacinda, I'm not familiar with trucking. Obviously, I'm not a trucker. How much does it cost to fill up your truck, and how much more are you spending now on fuel right now compared to a month ago?
Used to cost about $800, to fill up. Now we're talking $1,000, $1,100 to fill up a 250-gallon tank. So, and it's raising every day. Literally, you've seen fuel prices go up 40 cents, 50 cents, 60 cents overnight. And, an average fuel week was about $1,600. Now it's $2,400 a week.
You are blowing our minds, Jacinda, I think, with these numbers. So, Grant, if she's putting that much more in the truck, are carriers getting paid more, right? We see on the consumer level, we see prices going higher. Are rates for truckers going up too?
On average, no. The rates for truckers are not increasing as rapidly as fuel prices are increasing, and that's what's putting the squeeze on the small carriers in this nation.
Mm-hmm.
Why not?
So there are a variety of reasons for that. The primary one is a lot of the freight that's moved in this country is moved under contract, and those freight rates are set annually or less frequently, which makes it hard for the companies that are setting those contracts to flex to accommodate fuel prices that move so quickly. There are other reasons, obviously, but that's one of the primary ones.
Grant, how do you think electric trucks will change the industry? And there's so much hype around autonomous trucks, electric trucks, but to me it seems like a decade off, but maybe they're not. Maybe, I don't know.
I think electric trucks and autonomous trucks eventually will change this industry. However, I think your timescale might even be a little short. Mm-hmm. The reality is electric trucks will be impactful in large-scale fleets and private fleets where charging infrastructure can be built at the facilities where the trucks pick up and drop off. For the small truckers like Jacinda, they're dependent on public infrastructure to accommodate their flexible sort of work style where they're traveling everywhere and working in many cases with smaller companies that either won't or can't afford to put in charging infrastructure. And so much like the electric vehicle revolution in personal transportation relied on a similar revolution in charging availability, and companies making those cars had to go out and partner or work directly install charging stations for people to be comfortable. Something similar is going to happen for electrification to be meaningfully impactful for the small truckers of the world, which is 90% of the trucks on the road.
Yeah, and Jacinda, as we talk about all of this and the transitions in the industry and the higher fuel prices, I mean, do you ever think about giving it up and switching to something else? What keeps you trucking what keeps you doing it?
Trucking is a passion, and it's not always a job. To most of us, it's not a job, it's a passion. And you just have to ride the waves, the ups and downs, the lows and highs, like any industry. And trucking's one of them. And it's probably one of the first affected by fuel prices, consumer prices. We have to keep going. Essential. We're so essential, through this whole pandemic, fuel prices, everything. The truck drivers have continued to go the entire time. It's just what it is. But the strong will survive, and those who make it will definitely come out stronger, and I'd say more beneficial on the other side.
And I will tell our viewers too, they can follow you on social media. Remind me of your tag, Jacinda?
Jacinda Lady Truckin' coming at ya.
Jacinda Lady Truckin' coming at ya. She has a website, you can buy her merch and everything. This is the first interview we've done from the cab of a truck, folks. And it's been a good one. Yes, and we even get the dog in the back. Really appreciate you guys doing this. It's really interesting to get this insight into the industry. Grant Goodale is Convoy co-founder, and Jacinda Duran, carrier for Blackburn Energy. Thanks, guys. Appreciate it. Right now, we're going to talk more about what's going on with the pandemic and specifically where we are in vaccinations for the youngest people who have not had protection up until now. Moderna saying in the last couple of days it is going to be filing an emergency use authorization for children, the youngest children who have not gotten access to the vaccine as of yet. The CEO of Moderna is with us now. That is Stefan Bancel. Our Anjali Kamlani is joining us as well. Stefan, thank you for being with us. Appreciate your time. And as I said, parents of young children have been anxiously awaiting this news. What can you tell me about the potential timeline for the filing and ideally, I guess, for the approval?
Yes, good morning, and thank you for the invitation. So we're talking, still a couple of months to the availability of a vaccine. This is not a couple of weeks. I just want to be realistic for the parents that are waiting and have been waiting for a long time. We need to file all the data to the FDA. They need to review the data. Most probably, they're going to want to have an independent advisory board to review the data and provide feedback. And so we're talking a couple of months, but that should come pretty soon.
Stefan, Anjali here. I wonder, does that fall in line with what you're expecting now, the pace that the FDA and other regulatory bodies are taking? Does it seem to be a little bit slower and a little bit more deliberate compared to the first round?
Not necessarily. I mean, if you remember, we announced the Moderna phase 3 data in the adults. That was in November of 2020 now. And it took, a good month to get authorization. And that's the type of things we should, I think, expect to see. Again, with the young children, you want to make sure that the data is reviewed thoroughly. From what I've seen so far, and it looks really good. But they're going to want to go spend some detail and make sure that everything is correct.
I also wonder on the rollout for that, are we expecting that this might come in before the end of the school year, or does it look like more into summer when you're expecting some response?
Yeah, so, we are mid-March, so a couple of months. It's highly possible it's in the spring. I've heard a lot from parents who are really eager to vaccinate their kids as soon as possible. As you know, there's a new wave in Europe. With the BA2 that is starting to pop up, and you've seen the ratio of that virus in the US. So I can see some families wanting to do it before the school year. The other ones, of course, can do it in the summer to be ready for next time we go back indoor in the fall.
Stefan, talk to us about the latest thinking on boosters here, and not just a booster as well, but potential shots to address Omicron variants, et cetera. Where does Moderna stand in all of that process?
Yes, so in terms of the Omicron-specific shot, which we are looking as a pretty unique and novel, innovative way to do it, which will be 2 mRNA molecules in each vial, one containing the existing vaccine on the market that has been approved, and one being in a 100% copy of the Omicron virus. And the idea by putting both of them in the vaccine at the same total mass, so it will be half the mass for each component, is that it will provide us the ability to be ready in the fall, because what nobody can tell is in the fall, are we going to see a genetic daughter of Omicron as a new variant or a new one coming from left field? If we remember, Delta was not a genetic daughter of Alpha, Omicron was not a genetic daughter of Delta. And so nobody really knows what's coming next. And we need to be ready for it. And I think with this special approach that Moderna can do, that other technology cannot do as fast, we will be ready to provide protections to people who want it as come early fall.
Stefan, is the pandemic over this year? And what does over look like for people?
So again, I want to speak with a lot of caution and humility because the virus has surprised us many times and I've never managed a pandemic before. We believe that there's an 80% chance that the world slowly goes back to normal for most people. I want to be very careful and respectful of people that are, for example, immunocompromised. Until the virus really stabilizes and we have already a very high efficacy, those people are extremely high risk of being hospitalized or dying. But for most healthy people, I think, except if we have a very strange variant with higher virulence back into the fall or next year or the year after, I think that's a piece we just need to be careful. I mean, the good news now is with mRNA technology, and Moderna is very committed to adapt the vaccine as needed. And we have manufacturing capacity that we didn't have back then, if you remember, because this was our first product. When the product was authorized in December 2020, we only had 20 million doses to ship for the entire planet, and they all went to the US government. Where we stand now is we have 2 to 3 billion of capacity per year. So if something were to happen, we will be in a much more normal world, a bit like you see with flu, which is if you want a vaccine, you can walk to a pharmacy, it's available. So I think for people who will be able to use testing, for example, when you go see a relative that is at high risk, you're going to want to test yourself at home. That is available now. You can vaccinate and boost yourself. Treatments are available as well. So I think if people use the tools correctly, we can go back to a more normal life.
I wanted to ask Stefan about, as we are going back to a normal life and as the pandemic recedes in urgency, what the funding picture is going to look like. The US federal government, for example, has said its funding is waning for vaccines. Is that going to be an issue, not just for global health reasons, but also for Moderna's sales reasons as we head further into this year and into next year?
Sure. So indeed, the situation in the US is quite unique. Actually, this morning we announced an increased number of advanced purchase agreements with countries around the world. At our Q4 call on February 24, and if I remember correctly, I was with you as well, the number was $19 billion of signed APAs with upfront payments. Well, this morning we're increasing this number to $21 billion of advanced purchase agreements that have been signed by countries around the world, but the US. That number includes $0 coming from the US. So what is not clear today is, will the US become a private market, which is the case for all of the medicines we have access to, or is it still going to be in the fall where the US governments buy directly vaccines and make them available for free? Clearly, that has not been decided. As you well know, the funding is not available. So what we are doing as a company is to get ready for a private market situation. And if you think about it, in the public setting, when the US government was buying, the price of a vaccine was actually very low. The price that the vaccine was sold to the US government is actually much lower than what it was sold in Europe or in Japan, because we insisted when we supplied the vaccine contract back in the fall of 2020 to give a reimbursement to the US government for, you remember, the grant we got to fund the clinical study. And so actually in an endemic setting, I believe Moderna's average selling price for a vaccine will be higher than what it has been over the last 2 years.
I want to talk to you about that, Stefan, because I know also you're looking at globally, even with your pipeline and the other vaccines you're working on, you're looking at a global scale, specifically looking at setting up in Africa as well, and that helps with, the production going forward. So tell us the timeline of that right now. How quickly are you going to be able to, get products out, and how does that impact the future of your pipeline?
Sure. So now today we have 2 to 3 billion of annual dose capacity that we can make. We just announced last night actually a final agreement with the Australian government to build a new Moderna plant in Australia that is coming with a 10-year supply agreement of respiratory vaccine. We're trying to kind of set up a subscription or service type of model in exchange for building the plant on Australian soil. And in exchange for that plant being available if there's a new outbreak or pandemic, God forbid, that they can use the capacity we are reserving of number of doses for whatever virus they want. And as you say, we announced recently building a plant in Africa. It will, of course, take a couple of years to build a new plant from scratch, like it will in Australia. We're also having advanced discussion with Canada to build the plant there. But what is exciting to me is the pipeline. If you think, Angelique, at our vaccine day in 2020, we had 9 vaccines in development, 0 commercial, 0 phase 3, 1 was in phase 2. If you look at where we are today for Vaccine Day 2022, we have 31 programs in development. That is from 9. We have 1 commercial product, obviously everybody knows it, 4 phase 3, when we had none, and 9 phase 2. And this happened while our team worked really hard during the pandemic. And think about the cash resources we had. The last time we disclosed financials, we had more than $17 billion of cash. So investing that cash extensively. So think about where the Moderna pipeline is going to be just in 2 years from now.
All right. Thank you so much, Stefan. It's good to see you. Stefan Bancel is the CEO of Moderna. Really appreciate your time here this morning.
One of the activist investors taking on Kohl's has a bone to pick with another company. Engine Capital says tech investment firm Veritas is undervaluing shares of education services provider Houghton Mifflin in its deal to take it private. Engine Capital is a longtime holder of Houghton Mifflin and has a 2.7% stake in the company. For more on this, Engine Capital managing partner Arnaud Adler is here. Arnaud, great to see you here. Make your case. Why are you coming out in strong opposition to this transaction?
Well, hi, Brian, first, and thanks for having me. So look, we think that the $21 per share undervalues the company. Effectively, if we look at the 2024 free cash flow that the company is going to generate, we believe that Veritas is buying the company at around 7.4 times that free cash flow, and we think that's just too low for a good business that's growing, that's transitioning from being historically a textbook publisher to today being effectively increasingly an ed tech company, an education technology company. We think that that's too low a multiple, and that's really, at the core, we are value investors. Our job is to value businesses, and we think 21 is too low. That's problem number 1. Problem number 2, we think that the process was flawed. And we can go into that if you're interested. And then finally, we believe there's a better alternative for shareholder, which is to keep the company public and continue to ride the upside. And we have run some maths, which we have a public presentation. People can go on our website, don'tstealmyhmhc.com. And you can access the presentation. And we believe the company could be worth $42 per share, so almost a double in 3 years if the companies were to stay public.
Arnaud, you, Engine Capital and you as well are big names in this activist space. Have you had an opportunity to talk to Veritas? And if so, do you get any sense that they are likely to raise their offer?
Look, at this point, Veritas doesn't have to do anything. Veritas first has to see whether shareholders are going to tender their shares or not. So this transaction is structured as a tender offer. It's not structured as a typical merger agreement. So shareholders don't vote. Shareholders decide whether they tender their shares or whether they don't tender their shares. So the deadline to tender today, I believe it's around April 7. And so Veritas is going to stay quiet until they see whether people tender their shares or not. If less than 50% of the shares are tender, then Veritas has to make a choice, either to walk away from the deal or to increase the offer. Now, we have run the math. We think this is an incredible deal for them. At $21 per share, we believe they are going to generate an IRR of between 31 and 37%. So we don't believe they are walking away. So if shareholders stick together here, and if shareholders don't tender, and less than 50% of shares are tender, we think the odds are overwhelming that Veritas is going to end up increasing its offer.
No, it's Julie here. At the same time, it's my understanding you think that the company could continue and still do well, even if it was not purchased. Are there any changes, though, that it needs to make in strategy if it does not end up getting acquired by Veritas or someone else?
You know, the beauty of the situation is that the answer is no. This is a good business. It's run by an excellent management team. You know, the CEO, Jack Lynch, has done a great job over the last few years transitioning the business toward more a digital company. And so the company doesn't have to change strategy. Now, what we are suggesting, if the company were to stay public, we suggest the company do a Dutch tender offer and retire around 20% of its share outstanding between $21 and $22 per share. You know, the idea of the tender is to relever the balance sheet, not too much. You know, what we are suggesting is effectively taking a company that's today basically has no debt to 2x EBITDA, so conservative leverage, to juice the return for remaining shareholders, but also to effectively provide an exit for all the arbitrageurs who have now bought shares after the announcement of the deal. You know, the arbitrageurs typically don't want to stay long-term shareholders of a company, and so that's a way for them to exit at a slight premium to the $21 per share offer from Veritas. But you know, beside a little bit of financial engineering, we like the strategy. We like what management has done, and you know, we think the company is also a big beneficiary of the stimulus. A lot of money is going to school, and so HMH is a beneficiary of that. And we think there's a lot of upside keeping the company public. Now, again, I want to reiterate, I think odds are this company is going to be taken private, because either people will tender at 21, or more likely, if people don't tender, Veritas will have to increase its offer.
Arnaud, let's put this deal aside for a second. Now, yesterday we talked to Jonathan Duskin over at McKellen Capital Management, he told us he's keeping the pressure on the management team over at Kohl, still going forward to essentially almost nominate an entire new board ahead of the company's annual meeting. Now, you put out a very tough letter to Kohl's back in December. Have you talked to Kohl's, and do you think they will accept one of these numerous bids that have been reportedly that they have gotten this month?
Sure. Kohl's has been also an interesting situation. For months now, we have advocated for the company to start a process and sell itself. They're finally doing it. You know, it's interesting that you ask this question, because one of our concern all along is that the board has a too high a view of what the company is worth. And so they may end up rejecting offers because of an unrealistic view of what the company is worth. So we came out recently with a letter effectively telling the board, run a process, and in the final offer, you put that offer to the shareholders and you let the shareholder decide, as opposed to you, the board, deciding whether it's 69, whether it's 72, who knows? Rather than you guys making the decision, let the shareholder make the decision.
So Arnaud, do you think they do accept? There's been some estimates. I know Jonathan has told me that Kohl's could be worth $100 a share. Do you think they could accept something in the low 70s?
Look, I'm not going to talk for John estimate, but when we came out with our letter in December, we gave an estimate of around $75 per share for Kohl's. Which we think is approximately the intrinsic value of the company. So, people are today talking about, maybe high 60s, low 70s. So we are not very far away from that $75 estimate. I think given what's going on in the world, I think shareholders would be better off taking an offer in the high 60s, low 70s instead of taking, letting the company, be public. And look, I think the company had an analyst day a few weeks ago, and on that day, the stock came down 13%. And I think this was the market telling the company that they don't like the standalone prospect of the company. And generally, I think this is a company that can be better optimized in the public market. And so I think the transaction makes sense, and I think at the end of the day, the board is going to realize that. So look, I'm optimistic that there will be a good outcome, but you don't know until you see the press release.